Hello again, Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another 2-minute drill, Lessons in Valuation subscriber request series. I recently did a video on the defense industry, and I covered names like General Dynamics and Lockheed Martin, but I did not cover Northrop Grumman, and I had one subscriber that was disappointed because they had apparently asked me to look at it before. So I thought I'd go ahead and give you that one. This is kind of an adjunct to the one where I covered the other defense companies. So let's take a look at Northrop Grumman Corporation today. Now, the first thing I want you to see when you instantly look at a fast graph, you can see what kind of company you're dealing with. This is a company that's had pretty consistent growth. It had a really terrific year in 2018. You'd want to check and see why. Then it had some decent growth going through 2023, but there were some down years involved in there. The company pays a 1.7% dividend. That's the green shaded area, and that's the area below the gold line here. All right, so it's BBB plus, has about 48% debt, offering a 1.7% dividend yield. So let's go ahead and put weekly prices on and see how the market has treated this. Now, there was a time coming out of the Great Recession that most of these defense stocks could be bought at single-digit PEs. This was probably the best time to be buying them if you were a long-term investor. Even then, you had to wait patiently for a few years before the market start really putting more value on these stocks, if you will. But if you look at Northrop Grumman here and look at it more recently, we've had this period where even though earnings have been a little weak, and I can shorten the time frame here, and we can see that we've only had 3% earnings growth, the stock has essentially gone sideways with the accompanying volatility you're always going to see, but it really hasn't gone anywhere. Now, the valuation is trading at an 18 multiple. I would like to buy it at a 15 multiple, which is the orange line on this graph. So it's fully priced. It's not necessarily massively overpriced. But when you're considering the fact that analysts expect less than 6% growth going forward, if it did trade back at a 15 PE, you'd essentially make no money over the next 3 years. The only way you could really make money is it would continue to trade at a 17 multiple, and that would still only let you make about 6% a year. But keep in mind, you would have to be expecting the market to put a very high multiple on a company that was really slow growing. Now, I do want to also point out when you're dealing with FastGraphs, those of you who are subscribers, you can look at these companies with all these other different metrics, everything from price to sales, and look at how the company's valued. It's valued very high as relative to its historical. You can look at it valuation based on EBITDA, and it looks very highly valued. So you can look at all these different metrics with FastGraphs. So remember, this is a 2-minute drill. I'm just highlighting the company. Now, the company's had a very excellent dividend growth record, and it has a very low dividend payout ratio. That's this area below the goal line. It's been under 30% most of these years and around 20% for many years. So there's a lot of room. This is based on EBITDA. If you look at it from a standpoint of earnings or adjusted operating earnings, the payout ratio is still very, very low relative to what the company's earning. So it is a company that does offer some intriguing dividend growth, but I would like to buy it at a much more attractive price. It's still a little highly priced. Now, from a standpoint of dividend coverage, the company generates very good operating cash flow, and free cash flow to equity, which is the real asset test, also covers the dividend. In other words, the orange line is higher than the gold line. The cash flow is higher than the dividend payment. Now, from a standpoint of forecasting, I also want to point out that let's go ahead and look at earnings here. I'm looking at free cash flow to equity, but let's look at it from a standpoint of earnings and look at how accurate analysts have been. They've had almost a perfect record of within these margins of error getting the estimates right. So I'd put a lot of credence on that estimate. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, bringing you Northrop Grumman as a subscriber request that I look at. Again, I think it's a little pricey right now. I don't think it's a great investment. I think it's a really good company, but not necessarily a great investment. Now, if you liked the video, give me a like, ring the bell, subscribe to our YouTube channel for more videos like this, and take a look at subscribing to FastGraphs. I call it the value investor's best friend. Thanks for watching.